Mike Green. I'm here in Miami, Florida, and I'm sitting down at the ETF exchange with two guests, Stefan Schäuble of Solactive and John O'Connor of J.H. Whitney. Welcome, gentlemen.
Great to be with you, Mike.
So you guys are here to talk with us about a new index that you're introducing that is near and dear to my heart. John, you and I have collaborated over the past couple of years involving areas around U.S. national defense and national security. You have a background in that area. And you guys are announcing the U.S. the Solactive Whitney U.S. Critical Technologies Index. What is this index, John? What is this for?
Well, I will start, and Stefan can build on it. But the genesis of this idea was to come up with an investable index which would help accelerate and enable the flow of capital to 14 critical technologies defined by the Department of Defense as necessary for competitiveness across the globe in all aspects of the economy over the coming decades. And those range from highly developmental to highly mature.
And so this falls into a category of index, and ultimately there will be ETFs and mutual funds associated with that. At Simplify, we're collaborating with you to introduce downside protection within some of these indices or within some of these products. But the objective is to effectively create an innovation index that is designed to maximize the impact on national security issues. And that doesn't necessarily have to mean defense. It can also mean food security, or it can mean making sure that we're making the investments in infrastructure that allow products to smoothly transit across the country in the case of the Eisenhower, interstate highway system. When you think about innovation, obviously there's the NASDAQ, there's other traditional indices. Why do we need a U.S. critical one? Stefan, what do you see as how this differs from the more traditional innovation indices or technology-oriented indices?
Well, if you're looking into the last couple of years and the evolvement of the index industry, we started with traditional market cap weighted indices in all different kinds of flavors. So the NASDAQ is the benchmark actually for U.S. technology. And if you're just looking into how the economy over the last couple of years evolved, then you've got a lot of huge trends that are coming out to market, really starting from cybersecurity to robotics, from health insurance and topics like that, from electric vehicles, from renewable energy. So all of these topics are probably not have been existing forever. They start to come to market once relevant. And I guess bundling these new innovative themes into indices is something that index providers are doing. And when I met John a couple of weeks ago for the first time, and he presented me that idea, that is something that we have not seen in the index industry. That is something that is well received from our people. We hear the idea, we understand the idea, it makes sense, and then it's time actually to create a new index. And that is something that we are doing on a very regular basis. And that's why you get soon a real alternative to the NASDAQ.
So when you think about this type of dynamic, creating a unique innovation index with a demand behind it being driven primarily by issues of national security, what would you exclude? What would be the example of something that would fall into the NASDAQ that might not necessarily fall into this type of innovation index?
Well, our exclusion algorithm, if you will, really starts with the selection of the 14 discrete technologies. And these would be what I would say upstream companies as opposed to downstream closer to a consumer. So there's been a lot of technological development, but the closer you get to the application layer, the closer you get to the consumer is where we would tend to screen out. So we try to get the best fit for the core elements of the technology itself. So we're looking at, for example, hypersonics. Now, there's very few pure play hypersonics companies. Those would really come down to companies like Lockheed Martin, Raytheon, et cetera. But there's a growing ecosystem below those who are really focused on supersonic commercial aircraft. Mm-hmm. So it's really trying to figure out what's closest fit to the technology intent without getting too much dilution in it as you get closer to the downstream consumer. The other thing we do is what we call a geoeconomic risk rating to exclude those companies that have excessive foreign entanglements, which, as you can see recently with the sanctions on Russia, gave rise to jump risk or sudden event risk with respect to supply chains, customers, et cetera. So we exclude out those companies which have supply chain dependency in either adversarial or high-risk venues without adequate substitution.
Now, this is an important distinction, though, because when you say geopolitical risk and you highlight something like Russia, you're not targeting companies that could have necessarily exposure to the concerns of the U.S. government, per se. Included in that would be companies that have vulnerabilities to their domestic political environment. You mentioned
That's
to me
correct.
Alibaba, for example.
That's correct. So if you look at there's four countries that the U.S. describes as adversarial, as a term of art. And that's Russia, Iran, China, North Korea. And surprisingly, we would have screened out close to 40 Russian companies. Interestingly, Iran features and will feature increasingly on the world stage as they probably re-enter the world economy, both as an energy provider, but then also in some applied technology. But below that, there's a list of about another dozen countries which are not specific algorithmic factors in the model, but which we monitor because at any given time they could become a factor.
So this would not necessarily be Russia, but this could be political uncertainty. Uncertainty in Mali means that a mining operation would be at risk.
That's right. Or the big example that everyone is looking at today, and interestingly, the French bank Natixis published on last night, is what if the analog to Russia, Ukraine is in fact China, Taiwan? Their question was, could the OECD divorce from China, or could China divorce from OECD the same way the world is attempting to divorce from Russia? And their conclusion was no, in aggregate. But if you look at the hundreds of companies or thousands of companies which make up the aggregate picture, many of them could not survive it.
So when you think about that type of dynamic, is the objective to create the incentives either through capital allocation or through raising awareness to encourage companies to diversify their resources away and their supply chains away so that they get a better score on the Whitney Geopolitical Index, for example?
Well, the way I would look at it, Mike, is reverse that and say the object of the exercise is to defend the investor's interest. That this information is knowable, but we would argue is not priced into risk currently. That there are many companies that have single points of failure or high points of potential stress in their supply or value chains, and that risk is not priced. You see, if you think about globalization generally, in the West, we optimized for cost, and in the East, they optimized for control and market share.
Okay.
So as the production base and the industrial base migrated around the world over 20 years, as is typical for episodes of globalization, you end up with very, very high concentration of specific both functions and capabilities. So that's why you say, Apple say, actually, we could not build an iPhone
Without China.
And we certainly couldn't build it here. And then the question then becomes, is that a 1 in 100, a 1 in 1,000, or a 1 in 10 risk? One doesn't know. I think everybody is probably thinking about that slightly differently today.
Yeah, and that's really one of the things I would highlight is that the thinking on this has clearly shifted in the aftermath of the Russian invasion of Ukraine, right? It's been highlighted to us for a relatively small, relatively low level of economic complexity country in the form of Russia, pulling them out of the supply chain or pulling Ukraine out of the supply chain due to the disruptions can be catastrophic to supply chains on a global basis. If we were to think about cutting out the world's second largest, or depending on how you want to calculate it, the largest economy in the form of China, certainly on an export basis, that becomes much more complicated. And so when you think about this type of index, is the objective to get this into the dialogue to create, I mean, is this an ESG type framework?
Yeah, very much following the ESG model that ESG introduced factors which had not previously had a material element in either assessment of risk or assessment of opportunity. And so there was some initial work that said companies which generally speaking adopt ESG principles tend to outperform. And that, depending on how you define ESG and how you define outperform. But the point is, these are now material factors.
Right.
What we're doing is similar in a mechanical sense, highly dissimilar in terms of an intellectual content sense.
So the screening algorithm is
Right.
similar in concept. I'm going to identify things that I do not want to be involved with, or I'm going to identify things that I want to be involved with. But in one of the challenges here, and you highlighted this within ESG, is the theory that ESG investments have outperformed.
Right.
So, and you mentioned, you expressed some skepticism by saying, it depends on how you define outperform. How do you think about this, et cetera? Certainly, we saw a tremendous amount of enthusiasm for ESG and money piling in. Now, of course, we're having a lot of questions and soul searching around the concept of what is actually ESG. Is it simply checking the boxes? Is it trying to improve various forms of governance? At Simplify, for example, we've begun to introduce charitable funds that donate all the proceeds to charity. We think that falls within the ESG framework. This is a form of governance that is much more about nation states and industrial policy and the risk that exists to organizations from finding themselves on the wrong side of that. In the case of an Alibaba, for example, as we've seen in the last year and a half, but also potentially on what I might describe glibly as the right side of history, right? So there are objectives for a U.S. critical innovations index that are explicitly patriotic in their overall construction. When you think about that type of dynamic, who is the target audience here? Who do you see as a natural investor in this type of ESG framework?
Well, first and foremost, I come at it from a perspective of generating high risk-adjusted returns and generating alpha.
Okay.
That we believe that there should not be a trade-off. Essentially, what we are identifying is there are certain previously imperceptible tailwinds that are beginning to develop within these technology sectors and within the companies that best align with these technology sectors. For example, one of the principal areas of national competitive behavior in the coming decade is going to be semiconductors, generally speaking, and microelectronics. Both US, Europe, China, India, all have critical dependency on Taiwan right now. So if TSMC, Foxconn were not to open their doors tomorrow, everyone has a problem, right?
Yes.
So that's why you saw, starting last year, a competitive race begun that the U.S. recruited TSMC to build
In Arizona.
a $12 billion plant. Japan concurrently recruited TSMC to build a plant in Japan, and at the same time, in the PRC, they have an indigenous semiconductor strategy going as well. So if you get, and there was great debate in Congress. A bill has been passed in the Senate, a bill has been passed in the House. It's going through reconciliation right now, but tens of billions of taxpayer dollars are going to be contributed and spent in the development of domestic semiconductor capacity. It may be Intel, it may be TSMC, it could be others, but it will be here. And this is where we believe there's positive returns to skills-based analysis that says, okay, where is that money? How much is it? When is it going to hit? And where is it going to go? And that is one of a series of developing tailwinds for these companies.
And so when you think about that type of economic tailwind, so part of what you're doing is you're aligning the index with industrial policy as it's developing in the Western countries, right?
Correct.
So this is clearly
And the
an
East.
area of, and the East as well, right? So this is clearly a area of focus for the governments of Japan, Germany, the United States, where defense spending is going back onto the front burner. There's an increasing awareness of the dynamics, particularly of network systems, that potential enemies or potential adversaries, yes, I want to use the term correctly, potential adversaries could exploit to our disadvantage as the time comes. And as you've highlighted, there's some critical technologies, particularly in the defense space. You mentioned hypersonic missiles, that we've fallen behind a little bit.
Right.
So this would be an index, and this would be an investment strategy that would be designed to lead to future growth in those industries participating alongside the industrial policy as it's increasingly developed in the United States. When we talk about the return profile of this type of investment, are there particular risks that you think about when you think about a technology-focused index as distinct from a broad market index? Stefan, maybe we could start with you.
Well, first of all, let me quickly comment on one topic, the ESG topic. Yeah, is it outperforming, underperforming, or performing like the market? I guess it's still substantially too early to dive into that. Yeah. So the ESG framework developed over the last couple of years, and I guess if we are talking about performance, then it's overall something that is here for the long term. If we are looking into the index we are currently developing, then I guess it's pretty clear we are moving away from a broad market all cap index.
Yep.
Yeah. So overall, what you introduce automatically is tracking error risk. So overall, you will benefit, or you can theoretically also be negatively impacted. I guess what we have seen is overall the allocation of let's say capital and investment goes into the critical industries these days. Yeah? So overall, the industries are benefiting. How much of that is priced in, we'll find out. But I guess there's a pretty decent likelihood that overall, over the long term, these industries will benefit from actually a change of investment behavior.
Yeah.
And I guess if we are thinking about the index as well, I personally like the positive outlook, so overall positive investments into the critical industries. Yeah? And overall, the vehicle itself, the index itself is, let me phrase it very simple, useless. Yeah? If you don't have a vehicle that is linked to the index, then it's just a random number published somewhere. But if there are vehicles that are linked to the index, and if there are investors investing into such a vehicle, then of course you allocate capital, yeah, for sure in the short, but also mid and long term. And that is what we personally believe, that there's a certain and a good likelihood of overall the tracking error impact is a positive one and not a negative one.
So this falls into the general category, and regular listeners are very familiar with my skepticism around things like passive investments. But I want to emphasize that this is a very clearly active but systematic strategy, right? So you are actively choosing which factors to overweight. It's not dissimilar to, say, choosing value or ESG, as we've referred to, where you've decided to highlight a particular factor.
Correct.
Right? In this case, we're talking innovation that is tied to the United States objectives.
Well, yeah, Mike, and I wanted to broaden it by saying, look, one of the things we've begun to understand is that economic security and national security are the same thing. And that we as a nation state, like any other nation state, has to have a sustainable, strong economy to employ its people, provide its benefits, because every state ultimately depends on the willingness of the people to support it. And so it's this, what we're in the middle of recognizing is, and that's why is that this convergence of national security as economic security means that the traditional defense and aerospace, planes, ships, bullets, beans, and canteens is a very small factor when you come down to overall national security. Now, critically, you must be able to project power. You must be able to defend your interests and project power to shape outcomes, right?
Yes.
But that's why the future, as we talked about before, the trends at work here is we're in the middle of the very beginning, rather, of the fourth industrial revolution. The first having been, the water wheel, and now we're at the point where we're truly going to have the fourth industrial revolution, which is defined by extremely deep and diversified sensing, captive networks to gather data off of deep sensoring with an overlay of machine learning and artificial intelligence. And that will characterize this fourth industrial revolution. In that world, while the ability to project kinetic force is critical, the ability to defend that inherently electronic ecosystem, which runs from space to subsea, calls for a different set of capabilities in any economy. And so that's why I'm so focused on this, is because it truly is a growth engine of an economy at large. If you get space right, your economy is going to be healthy. If you get quantum computing, quantum science right, your economy is going to be healthy. Because within these 14, as defined by the Department of Defense, only 3 technologies are exclusively military-oriented. Even so, biotech, for example, is critically important.
Well, and biotech not necessarily for weapons,
No.
but for example, vaccine development.
That's correct.
Would be a good one. You mentioned these critical technologies, and obviously one of those could be something like energy. I assume it is energy security, right?
Right.
And we're seeing very specifically in a place like Germany, where you're from, we are seeing the impact of poor choices that were made that raised reliance on Russia, for example, in the past several years. Done under the aegis of this is an opportunity to reduce the carbon impact, moving from dirty coal and potentially polluting nuclear to relatively clean Russian gas, but at the same time introducing fragility into the system. Your objective here is to do almost the exact opposite. It's to say, yes, we understand that deglobalization, which falls into kind of the 3 Ds that you and I had talked about, and you speak quite eloquently around those. Maybe you could highlight what those are.
In my investment career, I need to keep it really simple because I have to compete with really smart guys like Mike and Stefan. And keep it at 3s. And first and foremost is deglobalization. I mean, it's really began in the sort of great financial crisis of 08, 09, but the movement of people, goods, capital, and ideas began to reduce. So this 3rd great chapter of globalization is now receding. The second is really decarbonization. And without derailing into a discussion of climate change, I think we would all agree that decarbonization has become a core component of national and corporate policy, that companies are behaving in a way to incorporate decarbonization. The problem is, in this transition period of decarbonization, and Michael Semblist at JP Morgan has written quite elegantly on this, that it's easier to get out of one generation mode than it is to get into the next one. So you can wake up one day and say no coal, but you have to say in something else. Mm-hmm. And the problem is, globally, we have been sort of leaning away from nuclear post-Fukushima. We've leaned away from coal, and we've leaned towards offshore wind, solar, and other smaller components of renewable and sustainable industry. But we've created a gap. Mm-hmm. And that gap, mathematically, at least from our analysis, really only gets filled by nuclear, because it's the only thing that can provide a base load supply.
Well, I guess it's an interesting topic, in particular for us in Germany. Yeah. So as you outlined, John, out of nuclear, first decision. Yeah. Everybody loves wind and solar. Yeah, but please not in my garden. Yeah, just somewhere far away from us. Yeah. So then we've got the dependency of Russian gas. Yeah. And I guess it's all about, what are the decisions that, let's say, a society can accept? Because overall, we can all make the decision to go away from nuclear, but it comes at a price that at some point in time, energy is becoming more expensive. Yeah. And I guess there will be a lot of conversations around that, how you handle that in the future. Yeah. Because it's very simple. We can now make the decision to go out of gas, but how do you fill the gap? And that is something where I guess there will be a lot of conversations going on there in the future.
Yeah. And then the third D is digital transformation.
Okay.
And digital transformation is one of those things which is fortunately exactly what it says it is. And that is infusing digital capability into any and all processes and systems to take out human-influenced analog processes. And so that's the insertion of machine learning, that's the insertion of artificial intelligence to drive efficiency and effectiveness. And those characterize kind of where people are trying to get, and that's kind of the path to the better place.
So there's 3 Ds of deglobalization, decarbonization, and digital transformation. When you think about the links between those, right? So I immediately think of decarbonization as largely a technology issue. You highlighted nuclear, for example, Stefan, in terms of the role, and John, I think we all kind of agree that nuclear is the one area that's going to fill this. How do you think about identifying a U.S. critical nuclear provider, right? I mean,
with great difficulty.
With great difficulty.
And I don't think the U.S., regrettably, the U.S. has become not even a fast follower in nuclear generation globally with the sale of Westinghouse.
Yeah.
So we have exquisite nuclear capabilities within the Defense Department for propulsion systems and weapon systems. But, there's only one traditional nuclear power plant under construction in the United States. And that's the Southern Company's plant. What the future is going to hold is going to be growth in 2 distinct categories within nuclear. One is going to be small modular reactors, and that would be probably 500 megawatts and down, and the equivalent of a generally standard size combined cycle natural gas plant. The UK, in their most current budget, has made a major commitment to SMRs. There's a couple of SMR companies in the United States, but our regulatory system is not enabling, it's inhibiting.
Right. And just very quickly on the UK, this is the Rolls-Royce order for 8 SMRs that was announced about a week ago.
Correct.
If I remember correctly.
And so the UK has also woken up to its own version of critical dependency in energy. And that is its 2 current large-scale nuclear power plants are both are all owned offshore, and in some cases by problematic ownership in certain cases. And so the other aspect of it is the very large-scale nuclear plants have become operationally almost impossible to build because no prime system integrator general contractor wants to take the liability.
Right.
That becomes so complicated that the organic, all this stuff has to work when we hit the switch, is not an offsettable risk. So I can't insure it away, I can't lay it off, and that's why everybody turns to the government. So I think the first vector is going to be small modular reactors. That will probably be reasonably well investable on a decent scale within 2 or 3 years. And then the next is, there have been very quietly, highly significant breakthroughs in fusion, finally, where people have been able to maintain the reaction process on a contained basis for about a half a minute, which doesn't sound like much, but they've had great success with that in the National Lab System. There's some technology coming out of Caltech. There's a lot of energy and a lot of early stage capital against fusion. The math works, the bench level worked, and so the second stage, mechanical engineers are sharpening their pencils So I think within the decade, that is going to be the mitigant to the what do I do with my spent fuel problem in traditional nuclear today. And so a solution is on the horizon, but we're still in this transition period, which gives rise to huge discontinuity risk.
And the barriers to investing in that type of space right now, is it a function of the technology is just not mature? Is it a function of you need to be a very large company to marshal the resources, and therefore this is a small project within a large corporation up until that point? Is it that the U.S. as government is not aggressive enough in deploying spending in these areas to help develop it in a moonshot type environment?
It's all of the above.
Yeah.
It's all of the above. And I would say that the government-corporate intersection is actually much healthier at fusion than it is at SMRs.
Now, one of the things that you and I talked about is one of the reasons for the need for this type of index and the increase in your emphasis at J.H. Whitney. You've introduced the geopolitical index as well, which is now being adopted by other entities that are looking to score in almost an ESG type framework, right? One of the things that you and I have discussed offline is this concept of this is the nation state reasserting its rights over the multinational corporation. Could you comment on that just a little bit?
All these comments are mine and mine alone.
Yeah.
And I'll sort of trust everyone.
Standard disclaimers apply.
Standard disclaimers apply. Across the West generally, we're seeing a growth in industrial policy type behaviors to shape outcomes. If you think about what happened in Operation Warp Speed, for example, where that is not something where the private sector would have spontaneously generated a solution to an acute problem in a period of time and at a scale which would have been relevant.
And just to orient listeners, this is referencing the vaccine development for the coronavirus.
So the government had to intervene to do two things. One is reduce risk by giving the indemnification, and then the other to introduce required capital. And the required capital was actually in two forms. One was an order for the product, so I'm going to give you a guaranteed revenue line, and secondly, I'm going to give you investment capital to get something up and going. Now, similarly, we see that Germany has a long history of industrial policy, executed quite cleverly in some industries, and I will say sort of less cleverly in others. I mean, Stefan, do you have a comment about the rise of industrial policy there?
Couldn't agree more. Yeah, there are always two sides. Yeah, but some were pretty good. Yeah, others were lacking.
Well, I mean, I thought Germany as a early mover in robotics, for example. Any opinions? KUKA was one of the great world-leading companies, and then suddenly it gets sold, and it seems like you don't see the energy in robotics coming out of Germany you once did.
Well, it is. If you are looking into the overall topic, yeah. So I guess there is from time to time you've got give the economy all the freedom, yeah, and from time to time I guess you should be substantially closer to where we are, yeah. I could think of, for example, Lufthansa, yeah. So German airline, yeah, and theoretically during the Corona crisis being bankrupt like all the airlines, yeah. So what do you do with that, yeah? So I guess it was clearly in the interest to have a national airline, which in the short term will cost you money. In the long term, it is something that is essential. Yeah. So I guess that is an example of actually something that overall went pretty well. Yeah. And there are other areas where we might have done the wrong decisions. Yeah. Often, we also need to think about, who are the decision makers. Yeah, are they always perfectly in their long-term views? Are they perfect in taking everything into account? From time to time, it's also easier to say, "Oh, 2 years back, I would have done it differently." Yeah, so that's always something. I guess it is like it is always. Yeah, we've made some great decisions, but as always, not everything was right.
And Mike, one of the other factors that's really being determined right now, when you talk about technology, One of the things is standard setting. And that is one of the great contested areas for the future. Who's going to set the standards for 6G and 7G and 8G? Who's going to set the IEEE standards for, electron interface at the substrate level? This is what's all in play right now. And the question becomes, for the last 20 years, the conventional wisdom is we're going to ever more common, ever more global standards. Now clearly have begun to reduce that. So, some of us are old enough that when we traveled in Europe, we had 14 different power plugs, right? You had 3 prongs, you had 2 prongs, you had round prongs, you had flat prongs. I never had the right plug for the right country at the right time. And it is likely, in our estimation, that you're going to be finding technology standard enclaves again. And a lot of this is so...
Just to be clear, when you say that's technology standard enclaves, you're saying the U.S. goes to 110, Europe is at 220, and different plug designs, et cetera. You're saying you expect to see an increase in that type of fractionalization.
Absolutely. And you'll see we're going from pure globalization, where everybody's plug works everywhere, to regionalization, compacts, where, okay, there may be an EU standard, there may be an AUKUS standard. There'll be different standards, particularly governing data, its generation, possession, and utilization.
So now this is one of these things that, immediately when you hear D, right? So deglobalization, decarbonization, and digital transformation is a little bit on the different side, but you tend to think of it as anti-innovation.
Correct.
But one of the byproducts of what you're describing is you can almost think about it as a evolutionary system where suddenly you are fracturing populations. You're saying this population gets split on one side of a continental divide, this population gets split on another side of a continental divide, and instead of interacting, they're going to remain largely distinct.
Well, the way I'd put it, Mike, is instead of the Venn diagrams overlapping, they'll be tangent. And so there'll be interfaces, but they'll be controlled interfaces. So it's like the old days of roaming when you came off of Deutsche Telekom onto Swiss Telecom. And that has to do with everybody, the sovereign is now asserting their rights in data. And that's what's going on with our social media companies in Europe right now under EU. Who owns this? And what are the constraints on the utilization behavior with respect to it? But I agree with your central point is it's actually spurring creativity.
Right.
Because it causes more experimentation where things can be interoperative but safe, for example. And that's the basic problem you're trying to achieve is basically, I'd love to have the frictionless benefits of globalization, but I don't want to accept the risk factors and the loss of control of globalization. So I need to do something that's more granular, but because it's more digital, I'm just pushing electrons, I'm not pushing freighters, we can make it work.
And so when you think about this type of dynamic, right, because one of the things I would argue that has stood in the way of industrial policy, right, and it tends to have a bad name, particularly 40 years after the Reagan Revolution and having seen Japan fail to become #1, et cetera, right, this narrative of a large industrial policy and centrally planning a society feels like it took a significant backseat to we're going to liberate market forces. But one of the things that I think you and I would both highlight is in many situations that actually became code phrase for let's sell out the crown jewels of the kingdom.
Correct.
In order for access to the next consumer market. Obviously, China is a perfect illustration of this, where critical technology transfers occurred. Partnerships were entered into in order to access that developing 1.5 billion consumer population that now are increasingly looking as somewhat sketchy deals at the best, right? The data and intellectual property in many situations was stolen, and now there's a very distinct question. We saw this in its fullest form in Russia with the pullout of many American companies, but I think this is one of the key fears as we think about China. Will we eventually see Apple forced to abandon its consumer business, or Starbucks forced to abandon its sizable consumer business in a place like China? If you're thinking forward 5 years, how much of a risk do you think that actually is when you think about your dynamic of something like a geopolitical index?
Well, what I'm not here to say China's uninvestable.
Okay.
Okay. I think the way to invest in China going forward will be similar to the way to invest in the West, which is alignment of interest. And as we talked about, it became clear to us over a year ago that companies like Didi, Alibaba, and others were becoming misaligned
With their own government.
with their own government.
Right.
That their government had said by passing two critical laws, one was the information law, one was the cybersecurity law, that data is a critical crown jewel of the country. And so whether it was, when you have millions of consumers, as in Didi, taking rides and traveling, and that data is outside of the supervision or even control of the government, it should have been obvious that that was not a stable situation.
So
Now, the flip side of it is, one of the things, if you look at, aggregate sources and uses of the People's Republic of China, they still need to benefit from inbound foreign direct investment and foreign portfolio investment to the tune of $500 billion to $1 trillion a year. Critical infrastructure is a component of that. So they created a dozen or slightly more officially sanctioned industrial and commercial REITs. So while residential real estate investment companies were collapsing, these new industrial and commercial REITs doubled over the last year. So that's the point, and it kind of reverses part of the original thematic. When I went to China in the late 90s, was liberating state-owned enterprises to be able to address market forces and run more efficiently. Okay, got that. However, if they become misaligned with longer-term objectives of the society, it's going to be a problem. So whether you're here or there or in the EU, awareness of your alignment with national or regional objectives is going to become increasingly important.
Well, and this is one of these interesting things when you highlight this, right? Because this has changed. If we go back to the late 1990s, early 2000s, the story in Russia or in China was one of liberalization. You wanted to buy the companies that were shedding the shackles of the central government,
right,
and becoming focused on shareholder interests. What you're highlighting is that story is now in the past, and in some ways, the dynamics of an ESG framework around this type of innovation index is becoming increasingly clear as the interests of the Chinese Communist Party, for example, increasingly diverge from the economic interests of shareholders in many situations.
Well, I mean, it's a risk, again, we would say has not been appropriately assessed.
How do you think
under President Xi, it has become bigger because the role of the party in both management and governance of all companies, both
become much larger,
domestic and foreign, has now become law and is now much more of a factor. So when you look at the charter and the corporate principles and the staffing and whatnot, the potential for divergence between shareholder interest and corporate interest goes up dramatically.
And just to orient listeners on this, I mean, this is the dynamics of inclusion of CCP board members by
Correct.
law, the inclusion of worker representatives, which is just another component of the CCP, et cetera. This is not dissimilar to some of the reforms that exist in Germany with labor representation on boards. It's just in this case, we're talking explicit inclusion of a political interest. So that's one of the areas where this becomes interesting. This is clearly an area that's growing in importance. Do you think that it necessarily, the emphasis on this, you and I talked about briefly this idea that this could spur innovation. If you're a government, can you use an index like this? Do you want to look to the market behavior of this type of index to get a sense for, is policy on the right track, on the wrong track, or do you want to look to the actual scores themselves?
Well, I think you want both. I mean, ultimately, capital flow, you want healthy capital flows for your critical companies and critical industries. And on the one hand, and on the other hand, I would argue that there are certain industries and companies in the United States which have been resistant to sort of, hey, we need your help. And so there's a tension between short-term gains, long-term interest that our system doesn't resolve well. So, one of the biggest changes over the coming years is going to be the rise of a Chinese domestic aerospace industry. So they will challenge the Airbus-Boeing duopoly in commercial aircraft. Similarly, it's one of their stated objectives and goals is to challenge the GE, Safran, Pratt & Whitney jet engine business.
Right.
Because those are critical to them. And if you look at it, the Western world's growth rate of commercial aircraft is about 1.5% over the next decade. Theirs is about 11%.
And it obviously depends on whether we believe that, but the
Right.
overall point is absolutely important, which is the traditional Western domestic markets are really not growing very rapidly.
Right.
Things like jet engine transport, the maintenance, the fleets are largely complete. And so all of the growth sits in places like China, which again has facilitated the desire for technology transfer because Boeing wants to buy access to that type of market.
Correct.
Right. When you think about the awareness in the corporate sector of the importance of this type of stuff, you shared with me an anecdote from a conversation you had with a Silicon Valley, a well-known Silicon Valley entrepreneur, sophisticated investor, involved with a large corporation. When you brought up the importance of national security, right, or the role of the government in asserting these dynamics, you had a great story about
Well,
that.
yeah, I mean, it will come as no surprise to you as a San Francisco resident.
Yeah.
There's a special kind of libertarianism that exists in the technosphere, which is basically leave me alone and let me exercise my wizard-like skills to great economic benefit. And so this particular fellow was chafing at technology regulations governing, data and capture, retention, utilization. He said, well, we're going to build essentially artificial islands outside of the
International waters.
in
basically.
international waters, and we're going to be free from the burden of that and put our data centers on there. And I said, well, that's really interesting. Who's going to protect them? And he says, well, what do you mean? And I said, not for nothing, as they might say, but, with a couple of dozen pipe hitters, we could probably take over your island in 3 hours. So at a certain level, there's a book called When Violence is the Only Answer,
Yep.
which kind of unpacks the trajectory to when you really have to defend your interests.
Yep.
And it's similar but when you talk in the boardroom of aerospace companies and say, well, all right, so Boeing, you were chosen as a special partner. How do you think about the trade-off between your interests and your vulnerabilities? And the focus is extremely near-term. It's cost and near-term. It's not resilience, sustainability, not in an ESG, but in an economic enterprise. And it's really, you have to align the time frames. So we focused our discussion at the wrong place, which is the management team. Whereas if I'm if I'm a major institutional investor, I'm going to have to own a certain amount of big stocks pretty much forever, right?
Mm-hmm.
So the dialogue to align behaviors with objectives historically has been with management, which is the worst place to have it, instead of shareholders and board members who are supposed to be thinking much more about the long term.
Mm-hmm.
And I think that's going to be a big change that comes in the future. Much like the ESG debate, driven by shareholders into the boardroom and then only grudgingly adopted by management.
Yeah, I tend to agree with that, and I think that we've been here before. You and I have had extended conversations around the dynamics of corporate behavior in the 1930s as we
Right.
prepared for World War II. Right, the most famous example, of course, is the aluminum monopoly of Alcoa, which at the time was controlled by DuPont, the need for aluminum for aircraft, both frames and skins, was extraordinarily clear heading into the rearmament for World War II. They were approached by the FDR administration, with the request to increase aluminum production so that additional supply and capacity more than anything else, so that additional supplies would be there for the eventual building rebuilding effectively of an air force. And the response from Alcoa was, oh, don't worry about the excess capacity. We've got plenty of excess capacity in our plants in Germany, right? That type of anecdote we're seeing play out, where there's similar resistance to investment, there's similar resistance to disaggregating and separating from China. And so with an index like this, you're raising awareness, you're increasing the profile, and hopefully the products that we develop, those both on a standalone for Selective Whitney as indices and on metrics like the geopolitical scale that you're creating that is being adopted by various institutions, those can create and raise awareness and start to focus and create the opportunity to invest in the companies that are ultimately going to benefit. And so this is an exciting venture that you've kicked off on to help raise awareness of this.
But it's also, interestingly, you couldn't do it without the digital transformation. So all of what we're drawing ultimately leads back to Reg SK reporting. But it's hard to get through kind of 10Ks with exhibits, with supplemental reporting on as granular a basis as one has to. Because, if it's a material joint venture or strategic alliance, it's going to be in there somewhere.
The thing that I love about this type of stuff, though, is that that's effectively a repurposing of the technology that's being built at the Facebooks, Googles, et cetera, of the world for that type of data analysis. So you've created that capability. You've made it available to people. If people want to find out more about the Selective Whitney Index, what's the best source of information at this point? And when does this go live?
So we are expecting to go live in the upcoming weeks.
Okay.
So we are just very close to get everything up and running. So you will find all the information on our website. So we've got a few things where we differentiate ourselves from some of the other index providers. You'll find the rule book. So the algorithm, how we select and how we weight the different index components. You'll find the current composition, so all the details of what company is in, what company is out. And we will also provide a lot of educational material so that people can really dive into all of these elements.
Fantastic. Well, I know that I'm excited about it, and I'm having fun trying to figure out the best ways to hedge this type of index and create and protect against some of the unique exposures that it has. But this is going to be a great product. I'm really happy that we're able to raise awareness of some of these issues. It's become so clear that supply chains and the investment in supply chains and the investment in robustness is becoming really critical, that this couldn't come at a better time.
Well, Michael, thank you very much for your time. We look forward to working with you because we, for one, certainly subscribe to the requirement for folks to be far more cognizant of managing sort of their market risk alongside of everything else.
Well, that's one of the best parts of my job is getting people to help, being able to help people do that. So thank you very much for joining us, Stefan. John, thank you, and I look forward to continuing the conversation.
Great, thank you.
Simplify Asset Management, Inc. is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Simplify Asset Management, Inc. and its representatives are properly licensed or exempt from licensure. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy. This website and information are not intended to provide investment, tax, or legal advice. This content is solely for informational purposes and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. These materials are made available on an as-is basis without representation or warranty. The information contained in these materials has been obtained from sources that Simplify Asset Management, Inc. believes to be reliable, but accuracy and completeness are not guaranteed. This information is only current as of the date indicated and may be superseded by subsequent market events or for other reasons. Neither the author nor Simplify Asset Management, Inc. undertakes to advise you of any changes in the views expressed herein. Past performance is no guarantee of future returns. Investing involves risk and possible loss of principal capital. Unless otherwise noted, any performance returns presented in these materials reflect hypothetical performance. Hypothetical strategies and indices presented are unmanaged, do not reflect any fees, expenses, transaction costs, commissions, or taxes, and one cannot invest directly in any of these. The results presented should not be viewed as indicative of the advisor's skill and do not reflect the performance results that were achieved by any particular client. During this period, the advisor was not providing advice using this model, and clients' results may have been materially different. Hypothetical model results have many inherent limitations, some of which, but not all, are described herein. One of the limitations of hypothetical performance results is that they are generally prepared with the benefit of hindsight. In addition, hypothetical trading does not involve financial risk, and no hypothetical trading record can completely account for the impact of financial risk in actual trading.